Everyone wants to become a smart investor, but there are very few people practically who become smart investor. So let us focus on how to become a smart investor. Smart investing is a part of the basic tenets of investing and enables making the right investment picks that meet your particular needs. With a vast arena of investment opportunities available today, it is obvious to pick a financial product or plan that is not the best for you. It is therefore important to be a smart investor to plan and utilize time and money to the optimum. Becoming a smart investor helps you to make the suitable investing decisions and identify the thin line of investment scams. Well, there are 11 smart tips to be a smart investor. The first, scrutinize the registration. Registration protects you from scams. Always examine that the business you are investing with is registered with the securities regulator in your state or country. The registration profile will also inform you of the products or services they are licensed to provide and if there have been any regulatory or disciplinary counteractions. Registration also helps protect you from void or fraud investment professionals or companies. Second, have an objective or plan of action. The short and long term as well as the contingency plan should be ready. Every individual's investing requirements and objectives are distinct. Having a plan of action means having a blueprint to arrive at short-term and long-term financial goals, which may have plans for saving for a brand new home, college education, wedding, or retirement thoughts. It equips you with a plan of action and can imbibe financial confidence. Life is full of uncertainties and expected situations and contingency expenses could crop up. A robust financial ploy will also help you better handle these unexpected happenings. Third, evaluate the effect of fees on investments. Fees can considerably impact your investment gains. You may have to pay fees or charges to buy, hold, or sell your investments. The most common fees include mutual fund fees, ETF fees, brokerage fees, etc. Examine the action of fees when picking an investment and get aware of the fees can and differ between products and companies. Fourth, comprehend the danger. There is always a risk waiting for you to lose the money you have invested. You invest for a return on your money. Risk and return are mutual. In common parlance, high-risk investments offer higher potential returns, and lower-risk investments have lower returns. This is known as the risk-return connection. Fifth, perceive the power of compounding. Make your investments increase rapidly by reinvesting. You can grow your savings by investing it to earn a profit. You can grow your money faster if you also invest the money you earn, that is, your return. This is called compounding. Sixth, acknowledge the benefits of multivariousness. Well, diversification can reduce risk. With regards to contributing, having a blend of various speculations can assist with diminishing danger and secure your portfolio from losing worth all simultaneously, particularly on the off chance that there is a slump in the business sectors. The right blend is different for every person and circumstance, yet It could incorporate an assortment of stocks, securities, cash, and different interests in various ventures, nations, or resource class. Seventh, security from scams or frauds. Have knowledge of the common strategies and techniques that the fraudsters use. Investment fraud is easier to make out when you have an idea. Always spend some time to research and plan before investing. Don't give in to sales pressure or tactics. Frame questions till the time you're satisfied that you have a good comprehension. If something seems too good to the extent to be true, then it is. Eighth, begin early investments. Investing as soon as you start earning provides you with an edge over others. And if it is not applicable, it is better late than never. Every investing assures that your money has ample time to grow into a substantial contingency fund that will cater you well in times of adversity or when you decide to retire. Ninth, regular investments. Investing just once a year or occasionally is not enough. In order to grow your money well, you need to invest a fixed amount each month or intervals. Carrying this financial discipline is crucial if you wish to accomplish your financial goals. Systematic investment plans, that is the SIPs, and auto payment options are some of the best ones to practice this and ensures that a stipulated amount of money is deducted each month without fail. 10th, construct an assorted portfolio. Diversifying your investments can help risk management and recapture financial losses in a case of distributed market. The economic instability caused by the corona pandemic is one of the best examples to quote. Investors who had concentrated their money into one type of stock incurred heavy losses, as in contrary to those who diversified their portfolio. Hence, it is always advisable to diversify your investments to a different asset class or category. 11th, stockbroking apps. Benefit of using stockbroking apps is the constant alerts on the market. It can be challenging to keep track of the market with everyday music, but alerts and updates of relevant developments provided by the application helps you make informed decisions. If used wisely, alerts can make you earn profits by keeping you updated. And here are some of the best ways to invest so you build wealth that lasts. First, stock ETFs and mutual funds. Second, low-cost index funds. Third, real estate or REITs. Fourth, money market funds. Fifth, online savings accounts. Sixth, treasury bills. Seventh, certificates of deposit. Well, I accept they are an incredible beginning stage. They can assist you with accumulating reserve funds, accomplish portfolio broadening, and enable you to begin creating financial momentum for a superior monetary future. And yes, don't forget to subscribe to the channel for future learnings. Thank you.